James, thanks for joining us. We've heard then from Momentum Investment Director Glyn Owen about his thoughts on markets. In that context, how did the Harmoney portfolios, how did they fare last month?
Well, May was actually a reasonable month for the Harmoney portfolio range as a whole. It didn't necessarily seem like it at the time, but there were relatively low differentials between the equity markets and the bond markets, and they all went up ultimately. And in those kind of environments, we saw decent returns from the funds, around 1 to 2% in absolute return terms in their local currency, net of all fees, of course. And over 6 months, the returns are looking pretty healthy as well. They are greater than over the 1 month period. As you'd expect, markets have done reasonably well over the 6 months, but perhaps not as well as you might think. This last 6 months has been relatively muted compared to the 6 months before which was a really sort of a gangbusters period for the markets, if you like. And so the 12-month numbers, you're looking high single, low double-digit style returns, and then over the longer term, of course, still a high consistency of those sort of high single-digit returns, net of all fees from the fund range. So yeah, again, just to conclude that, really good returns from the Harmoney portfolios in May, consistent returns across the board.
And what were the main kind of themes we saw last month?
Well, the overriding theme really was one of low volatility. We've spoken about it a number of times in these recent podcasts, but May was exceptionally low volatility, and it's something we should bear in mind when we think about how the funds have performed. It's quite interesting because I think that there are two different driving forces behind the equity component and the bond component. Bonds really, interest rates dropping a little bit, reflecting this lower for longer idea, and making lower yields comfortable for investors, if you like. So you've got a smallish but reasonable positive total return from the bond markets, particularly the sort of high quality end of the bond markets. And then on the equity side, these kind of benign conditions were just sufficient for the equity markets to just keep ticking over. It's a little bit interesting because the economic background, I suppose it wasn't surprising, but it did have some interesting nuances that could have thrown the equity market off course if sentiment had been a bit weaker. Things like US GDP was a bit weak. We know why that was. It was a weather phenomenon, but nevertheless, these kind of pronouncements can spook the market in different times. European GDP was pretty weak as well. If you take Germany out of the picture, Europe probably shrank over the last quarter. Japan's GDPs did surprise on the upside. That was largely due to consumption being brought ahead of a retail sales tax increase, so that kind of splurge on consumer goods before the tax increase came in. Obviously now we need to wait and see what happens in the coming months as to whether consumer spending, which will drop off, whether it comes back or not. That's the sort of key balance there for Japan. The other thing in Europe, coming back to local markets for us, of course, is we had the European parliamentary elections, European-wide, and it's interesting to see the proliferation of Eurosceptic parties now in the European Parliament. I don't think it's necessarily an issue for the markets, but it is interesting. It's an interesting signal for how the European project is going, and maybe it spells out a bigger issue or maybe a bigger solution in the long term for the European problems that we see today.
Is this something, say yourself, Momentum, will they be keeping an eye on that, or is it very early days?
It certainly is early days. It's something we consider. I don't think there's anything we can do to profit from it today. But clearly it speaks to the European project, the longer term connotations of that. We do think that ultimately, if you're going to have a currency union, you need to have some kind of financial and banking union. We're a long way from having that today. But the good thing that we are seeing in Europe is the ECB increasingly does seem to appreciate the need to paper over the cracks, keep the system turning over, while in the background the slow-moving cogs turn to create a more efficient financial system overall. So Draghi, ECB president, famous for saying he'll do whatever it takes to save the euro a couple of years ago. Now, we're looking like doing more stimulus, whether it's negative interest rates for reserves of banks, could even go as far as some sort of QE in the longer term. But again, clearly Draghi, reflective of a Europe which is much more pragmatic than perhaps Jean-Claude Trichet was, his predecessor at the ECB.
Very interesting. We're recording this obviously ahead of Thursday. No to European QE. Is that fair in your opinion?
That's what's priced in today. Yeah, but we do expect some sort of loosening measures like negative deposit rates, for example.
Absolutely. James, in terms of your kind of decisions where to allocate monies in the portfolios, what were the key decisions that influenced performance in May when looking at Harmony?
Well, it's interesting. We've had these conversations a lot recently. We've talked a lot about the regional differentials and how much they've impacted the portfolio. Now, emerging markets outperformed the broader equity market, but putting that aside for a minute, there weren't massive regional differentiations throughout the Harmony range. So it was much less a case of, having a large weight in one particular local market, and clearly that's a standout fund. At the same time, it wasn't a particularly rewarding month for asset allocation either, because equity markets drifted up, bond markets drifted up a similar amount, and so the impactfulness of asset allocation was somewhat reduced as well. Having said that though, the clear differentiator across the range, if you like, is really the equity weight in the funds. So the balanced funds, producing positive absolute returns, but on the whole, with one or two exceptions, producing lower returns than the growth funds. When we sort of drill beneath that, the funds are overweight emerging market equity. That region outperformed the broader equity markets. That's a positive contributor to performance. Within the fixed income portion, we're underweight fixed income as a complete sort of grouping. And within that, we're underweight the government bond markets within the broader fixed income complex. Overweight credit, and by that I mean things like convertible debt, strategic bond mandates, investment grade debt as well, which performed roughly in line, maybe a slight return enhancement over government debt, but nothing material. So again, really within that part of the funds, we were sort of neutral. Big position to be overweight cash in the funds, particularly in the balanced funds. In a month like May, that doesn't really help because most things drifted up. Cash clearly doesn't over these kind of periods at the moment anyway, and as a result, that would have dragged on performance a little bit. We still think that's a great position to hold. Over long term, it's a store of dry powder, and we look to put that to work when the time is right. And then the other thing, property securities again had a good month, and we've got a decent allocation to property securities in the fund, so that's a positive attributor there.
Thinking about that cash component very quickly, if I were to come to you and say, James, why not just own the US 10-year? I mean, you're still getting something, surely by way of a coupon.
Yeah, you do. I mean, that's a reasonable strategy to follow if you think interest rates aren't going to move. Then you still get 2.5 on a 10-year bond. The problem is we think the interest rates should drift up from here. They are particularly low today. They're not very attractive, and certainly in terms of real returns, you get a sniff of inflation that look very unattractive.
Yes.
And if you get an increasing interest rate policy out of the US as well, it's likely to drift up. So we think in a world where interest rates start going up, the coupon you receive on your bonds is fixed. So as a result of that, your price has to fall.
Yes.
And in that kind of environment, clearly cash is more advantageous.
Yeah, and in terms of that risk reward spectrum, what's on offer there and stuff like that, it doesn't look attractive to be in these, to be locking your money up in these fixed bearing securities.
It's asymmetrical, the risk today. I think it's the potential upside is very limited. At best, you're probably going to get the coupon from here. You might get a tiny bit more capital appreciation if you get risk off period, but you can easily see negative absolute returns in markets where yields start going up, which is not particularly attractive for this asset class.
James, how are the Harmony portfolios positioned today?
Well, the fund range is broadly neutral in terms of its equity allocation overall, but with an overweight to emerging markets on the understanding we think that's better value, better risk-adjusted returns than the broader equity market as a whole. The fixed income portion, we are underweight fixed income and underweight governments within that, with overweight to the credit market as we've already discussed. Within the property section, we're underweight property compared to our long-term asset allocation. We mitigate that with the use of infrastructure securities, which is a similar asset class we think better valued, and so our property allocation overall is neutral, let's say. And then the cash side, overweight, particularly in the balanced funds, less so in the growth funds, but again a store of dry powder should we need it.
Okay. And then finally, James, kind of looking forward, what are you seeing over the next few months or so?
Well, I think there's reasons to be reasonably optimistic looking forward to the rest of 2014. Activity seems to be picking up in the developed markets. Things don't look too bad in the emerging markets, but there are still risks. You've got an unwind of extraordinary monetary stimulus to come in the US, probably the UK as well. That has to be handled very well, and the risks of a policy misstep are high. We've clearly got a bit of a credit bubble in China that needs to be addressed. There will be losses. We've already seen some losses realised. That's likely to continue. But at the same time, we know the Chinese government is absolutely set on making sure they get a growth of about 7.5%.
Yes.
So, these are examples of risk. Russia and Ukraine is another example. Geopolitical risks are very hard to predict, but it never goes away. So again, while we're reasonably positive on the outlook, equity markets today, not cheap, they're not particularly expensive, more or less fair value.
Yeah.
That's probably our asset class of choice today, even in a world where it's not cheap, because the alternatives, particularly in the fixed income land, are looking increasingly expensive and increasingly unattractive on a long-term view. So again, broadly constructive, but cautious, and remembering to remain diversified. There's no point putting all your eggs in one basket. You're not rewarded by the market for doing that. So keep your asset mix sensible. And finally, we've mentioned already, keep a decent slug of cash, looking to invest that when markets come off.
Yeah, and you've got a decent kind of handle on valuations. You come in tomorrow, equity market has gone up 10%, bonds have sold 20%. You're kind of ready. You're ready to rotate the portfolio. You see these things moving.
That's a very easy thing for us to do.
Yeah.
The way the funds are set up, the way our trading systems are, we can implement those kind of trades very quickly if we need to.
Absolutely, James. Thank you very much.
Thanks, Richard.